Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
As when you are out of the money, the value is the value of your option. The premium you pay is very cheap, but the leverage when the price of the underlying is going up is going. The leverage is also very strong and very high. So out of the money options are products for people who are whiskey takers. And that's some kind of that kind of option I use mainly because we are trading on a time horizon between 3 days to 2 weeks, 1 to 2 weeks. So I need to take some risk to achieve my goals, and because my stop loss is not far away, and my risk reward is very high. I can afford taking risk with that kind of options. So that's why I usually choose strikes between the last price of the underlying of the pair and the target. I will show you example just after. Next slide. How do we always speak about volatility? So I guess you don't speak about volatility in your everyday life, but in the option world, volatility is a great part of the option pricing, because you must know, maybe you already know, that an option is quoted by a market maker, which is who is part of the of an exchange. And he has to find a value to its option. And to find a value to its option, as I said in the previous slide, you have the intrinsic value, the difference between the strike and the price, the last price of the underlying, and the value the trader, the market maker, estimates is the best appropriate for the time remaining of the option. So this part, there is some probability matters in this value given by the market makers, and to calculate the price of this option, it uses some mathematical tools and some formulas, such as Black-Scholes models, and this model takes into account the volatility of the market. So the volatility is the probability that the option could note, for example, a note of the money option could be in the money before the expiration of its contract. So maybe Steve want to add some things, or this I can continue if.
Yeah, Christophe, I would like, if you don't mind, could we go back to one of your trade recommendations and show the attendees that volatility cone, and just talk about how the volatility has been declining and what that really means? Is that okay? Can you do that?
On a recommendation?
Yeah, because you oops, I just.
Yeah, I don't have the.
Yeah, on the bottom. See that volatility? You know, the cone on the bottom there.
Yeah, but it is
it's hard to see, right? But at least you could explain what's been happening over the last 12 months. The red line meaning whether you look at it from percentage or, yeah, the percentage. Just the idea that perceptions have been that we're going to have lower volatility, and we've seen that for about 12 months now. Are we at the bottom of that? Who knows? But if we are, option buying is going to be a lot better for investors. And when you're in a declining market, it's harder to buy options because you're sort of swimming upstream. You might be right on your prediction, but if volatility is declining, a lot of your gain could be actually offset by the volatility declining, right?
Yeah, exactly.
So that's important, guys, and I would urge you to, as Christophe said, to keep your eye on this implied volatility. And one thing you might want to do, as Christophe has made, they make the recommendations, is you might want to think about spread trading when the volatility is declining. But when you're swimming upstream, that's of course when the volatility is declining, you might want to do spreads. But when you're going with the flow, and we might be in that market very, very soon where volatility starts to increase, the straight purchase of options is probably the best strategy. Christophe, would you mind commenting on that?
Yeah, I have some slides about it, and I will comment with a chart example.
Great.
So maybe yes, that was my further slide about volatility increasing. So you can see on the left low volatility, and on the right high volatility. You can see that the price is much higher in case of high volatility. And so even if you are in the good trend, and any pullback could activate your stop loss, and in fact this could be very dangerous. So this is a kind of dilemma sometimes. Do we trade the option right now, or do we wait for a pullback to take advantage of a lower volatility and a lower price in the option, and we can find some technical patterns to allow us to lower the risk and find patterns where the volatility is at the minimum level to invest in the best way. So this was this slide. The best is always to anticipate the move, because when you anticipate the move, the volatility on the market is still low. So and options are cheaper because volatility is a great part of the price of an option. And then you can take a risky product deep in the money, or in the money. In the money is sufficient. Out of the money, sorry. Out of the money product. When, for example, the price break out a huge support or a huge resistance, the move will be very strong. And then, as Steve said, if you enter into position right now, right at the breakout of the level, you may pay a sur-evaluate option and pay too much. So this is, as I said just before, this is a great dilemma. Do we enter right now and take the movement, but we can be stop loss stopped if a pullback occurred. But if the pullback never occurred, you are not into position. So this is a choice you should make. Or you can wait for the pullback. The price will come back to the previous support or resistance, and then you can buy your option in the following the trend. So in this case, we'll take advantage of the lower volatility, and then a cheaper price.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.